Well, hello, everybody, and thank you for joining us for the March edition of the Retirement Plan Academy. Our topic for today is ways to increase 401k participation. So my name is Kevin Fillers. I'm with the Trust Company of Tennessee. Along with me today is Adam Davies. Adam is the Vice President of our Retirement Plan Services Division. We had a great special guest, Josh Itso, teed up to be with us today, but unfortunately, Josh had an emergency medical condition and will not be in attendance. So we wish Josh a speedy recovery and hope all goes well. Josh is the founder and CEO of Femetrics, the author of the Fiduciary Formula, and host of the Fiduciary U podcast.
And we've checked out plenty of his podcasts, read his book. So if any of you are looking for a good read on how to improve your corporate retirement plan, definitely check out these two resources because they're great.
So just a couple of pieces of housekeeping before we jump in. We are offering SHRM and HRCI credit for today's webinar. To get those credits, you have to stay for the duration and also answer the 3 poll questions.
And we're in the process of applying for CPE credit if we have any CPAs on the call today. This webinar will not currently be approved for that, but that's something we're hoping to offer in future webinars. But we'll have the same process where you'll have to stay for the duration of the webinar and answer the 3 poll questions in the future once those are approved.
All right, so let's jump into how to increase 401k participation. So that can be accomplished a few different ways, whether through plan design features like auto enrollment and auto escalation, or through plan sponsor controlled enhancements like matching formula, investment choices, education programs, and something that we like to do here at the Trust Company is 401k Day. So let's actually tee up that first poll question. So do you as a plan sponsor feel it's your responsibility to encourage your employees to participate in the retirement plan?
Got a couple different options here. Yes, no, it's a shared responsibility, or indifferent. No wrong answers, just pick whatever you think best fits your perception. All right, got a couple yeses, so that's great. A lot of people also thought it was a shared responsibility. Pretty interesting that no one said no or indifferent, so looks like we have a lot of good folks on the call today. So Kevin, why don't we jump in and talk about plan participation?
Sure. So as you can see from this slide, across all the different segments of retirement plans, from what we call small market plans to all the way across to jumbo plans, the average participation rate is about 79.2%. Now that is kind of skewed because of those large plans, but as you can see, even in the small market, average participation is about 75%. So think about that for a second. How does your plan compare to the national average, and how can you improve your participation?
You know, sometimes I get plan sponsors that say, you know, I see on the report, here's my number, my plan participation stat. What would you consider as a good, or, you know, maybe a participation rate that needs a little bit of improvement, Kevin?
I really think it depends on your industry and the type of workforce that you have. But again, look at these stats. So figure out where your plan is. If you're a small market plan, so anything really under $5 million, I would try to benchmark against that 75%. And if you're a larger market plan, again, benchmark against that.
Awesome. And, you know, perhaps if your plan is a little bit below that, that's exactly what we're trying to solve for in this call today. So let's jump in and talk about some ways you can move the needle. So one potential easy way to get more people to participate is shorten the amount of time before they're eligible for the plan. So, you know, plans will have an eligibility period, and that essentially just states, how long do they have to wait before they can start participating in the plan. Some plans allow for immediate eligibility. You can join as soon as you're hired. Others have a certain waiting period. That might be 3 months, 6 months, or a year. But as you look across plans nationally, the most common eligibility period is immediately. About 36% of plans, do offer immediate eligibility, but that's definitely skewed by some of the larger plans. If you look over here on the right, those very, very large plans, more than $1 billion in assets, about 83% of them allow for immediate eligibility. If you're looking towards some smaller plans, those for small businesses, probably the most common eligibility period is about 1 year. So what are some considerations that would help you determine whether you want to do immediate eligibility or maybe have some sort of waiting period? And Kevin, I don't know what you think, but typically we recommend people look at their turnover. So, do you have a stable workforce? Do you hire people frequently or infrequently? If you're hiring people pretty often, maybe you have seasonal employees, maybe they tend to leave pretty quickly, you might be better served to have that 1 year or 6 month eligibility period. But if you currently do have an eligibility period and you find that people tend to stay with your organization very long, you're not hiring people that frequently, you might consider shortening that to immediate eligibility to allow them to participate that much sooner.
Yeah, and I think one thing to factor in, your eligibility period has a direct impact on your administrative duties. So again, if you have a transient workforce and you have immediate eligibility, you're always going to be enrolling people and then have small balances on the plan that you're trying to get out of the plan. So think about your administrative duties and how it relates to your eligibility period.
Definitely. We wouldn't want to see a lot of people come in the plan, stay for 3 months or 6 months, build a $500 balance, and then, end up leaving. So definitely looking at your employee turnover is the main consideration here. So if we look at some other options that are available, probably one of my favorites is something called automatic enrollment. And so if you think about a normal retirement plan, how it operates, you have to opt in to participate. You have to sign a sheet of paper that says, I want to save 3%, I want to save 4% of my salary. And so, that's on you to say, I want to opt in and participate in this plan.
So Adam, how often do we see plans adopting auto enrollment now?
It's definitely becoming a lot more popular. It really started with the Pension Protection Act of 2006, so about 15 years ago, and since then has been really gaining in popularity. We see about 46% of plans nationally offer this, but again, that's definitely skewed by some of those larger plans. We are starting to see a lot of smaller plans adopt it as well. And one of the reasons for that is that participants actually seem to stay invested and not push back against it. So if you look at the stat at the bottom, only about 1 out of 8 participants will actually opt out if automatic enrollment is added to their plan. So if you look at it the other way, about 85 to 90% will actually stay put and stay invested. And that's one of the great things about automatic enrollment is that it uses inertia in participants' favor. So we're all busy, we all have a lot of things going on. Taking that one decision out of the equation, whether to participate or not participate, is really a good way to get people on that path to saving so that they can have that meaningful retirement.
Where should a plan sponsor, start their default percentage? How do they know where to start it?
Yeah, that's a really good question, and the typical answer is it depends. Most commonly, we see somewhere between 3 to 6%. But what I would say is, look at your match and try to base it off of that. So maybe if you offer 100% match on 3%, 3% would be a really good place to start because then they're fully taking advantage of the match right off the bat. Maybe if your plan has a higher match threshold, say 50% of 6. It'd be great to automatically enroll them right at 6%, but you'd want to consider that initial paycheck effect and consider, are employees going to want to defer 6%? Typically, we see 6% as that threshold. As anything below that, they're okay doing. but anything above 6, you start to, really have participants notice it and choose to opt out. But these are all things your retirement plan provider can help you with. But short answer, I'd say between 3 to 6%.
Okay. A great kind of story about auto enrollment. We had a plan that historically had about a 40% participation rate. We discussed auto enrollment with them. They were a little hesitant to add that feature in. They finally did adopt that auto enrollment, and within 3 years, their participation jumped from 40% to 90%, and they have very little opt-out. So it's just a great way to encourage your employees to participate in the plan. And with that, let's jump into poll question number 2. So what is the average auto enrollment deferral rate?
So we got a couple options: 1%, 3%, 6%, greater than 6. I hope everyone was paying attention during the last slide and listening to some of the recommendations we gave. All right, 3%, 6% were the common answers. I'm happy to see no one said greater than 6%. So Kevin, what do you think?
I think 3%. Excuse me.
I would agree. So the most of the people on the call picked the right answer, 3%. But again, there is no wrong answer there, but 3 to 6% is typically what we see. So Kevin, let's jump in and talk about another feature. Sometimes these are combined with auto enrollment. Can you tell us a little bit about auto escalation?
Sure. So auto escalation is basically a feature that a plan sponsor can add in that increases the participant's deferral amount by 1% annually. So that can either be the participant's anniversary date, or that can be a certain month when raises might be given annually. So it just helps participants annually increase without them having to think about it, because most financial experts believe that the average participant needs to save about 10% of their income annually. But personally, I know if I tried to just jump into a plan and put 10% in, that might be a little bit, hold on, that's a lot coming out of my salary. So this is just a way to gradually increase a participant's deferrals until they max out at a cap.
So, for example, I work with a plan that tends to give raises every February. And so what they do is, they try to implement this auto escalation right when they give those raises in February. So, maybe in a given year, they might raise salaries 3%, but then you have a 1% increase in your 401k contribution. So the net paycheck effect is that their pay is still going up, but their 401k is also going up as well. And you just don't see it impact the bottom line as much because you're kind of adding it in at the same time their overall salary is going up. So, to avoid that sticker shock, suddenly saving 10% of your pay, maybe you auto enroll people at 3%, give them 1% increases each year, and in just a very short time period, they're able to get pretty close to that 10%. So, Kevin, how often would you say you see this in retirement plans these days?
Auto escalation typically is not a feature that was very popular. We do see it becoming more and more popular. Some plan sponsors feel that auto enrollment as well as auto escalation combined together can be a little paternalistic, but these are features that the DOL has approved to be inside your plan to show that you have a due diligence process for encouraging your employees to participate in the plan. So we are seeing auto escalation becoming more popular. Again, it just depends on your size of plan and how you've got your plan structured. But we are seeing it become more and more common.
So you mentioned that some plan sponsors think of it as paternalistic, and I like to look at the numbers and the results, what participants are thinking. And so pretty similar to auto escalation, we really don't see a lot of participants push back against this. You can see the chart at the bottom, but only about 1 out of 5 will actually opt out of auto escalation. So about 80% continue with the program. And so I really think that boils down to the fact that, saving for retirement is so difficult. People don't know how much they should be saving, how they should be invested. And so, features like this are really helpful to them because it gets them on that path in an automated way, so that they don't have that sticker shock.
And two, participants are kind of creatures of habits, just like all human beings. If they don't make a choice today, they're not likely to make a choice tomorrow or the next day or the next day, or a year from now. Oh, I'll just join later. It's out of sight, it's out of mind. So auto enrollment and auto escalation again are just ways to help people secure themselves for retirement.
So, Kevin, what about an employee that maybe stays with your organization for 30 years? Could auto escalation ever get out of hand and, maybe after 30 years they're saving 30% of their pay?
No, no, no. That's a great question, Adam. So auto escalation was introduced with the Pension Protection Act of 2006, and it had a cap of 10%. And then with the Secure Act, that actually raised auto escalation to a cap of 15%. So there's no way that it could get out of hand and continue on for multiple years.
And I think it's worth pointing out that those caps, the 10 or 15%, that's just the maximum that you're, granted fiduciary protection for. So just because the cap is 15 doesn't mean you have to do that in your plan. You can definitely set much lower caps, if you feel that that's too high. Why don't we talk about some other features? Kevin, what exactly is a re-enrollment?
So a re-enrollment campaign is something that a plan sponsor can consider if they adopt, if your plan's already in action and they adopt auto enrollment or auto escalation. A re-enrollment can take anybody who's not currently participating or who's not participating up to the full auto enrollment and actually puts them back into the plan. It could be re-enrolling participants again that aren't participating, or those that are saving below the default deferral rate, or those not invested in the qualified default investment. So it just again re-enrolls people that aren't participating and just helps you incentivize people to be in the plan.
So there's a couple different forms that this can take. The focus of this call, of course, is increasing employee participation. So, re-enrollments in that light would tend to focus on either getting people to start saving in the plan or getting them to save more. But, you could also look at how they're invested, and if they're not in the plan's default investment option, typically the target date funds, you'd say that's another avenue that you could pursue with re-enrollments, Kevin?
Yeah, in putting somebody that's already made an investment election and putting them in the target date fund, Adam, why would a plan sponsor do that?
Well, again, prior to the Pension Protection Act of 2006, we saw a lot of plans have stable value as the default investment option. I know I look at plans all day long, and I'll sometimes come across plans with 30, 40. I've even seen plans with 60% of assets in the stable value fund. And so, that's great in that there's really not going to be much volatility in their account, but it's really not going to be serving them over the long term because their accounts will barely keep up with inflation, let alone growing to help them develop a meaningful account balance. So in some situations like that, we think those are the perfect candidates for re-enrollments, on the investment side. But sometimes if you're trying to increase participation, how much they're saving, if you see a large percentage of your workforce aren't participating, or maybe you're just saving 1 or 2%, this could be a really good way to move the needle quickly. The one thing we would stress, though, is that communication is key. So anytime we do this with any of our clients, we typically hold a meeting 30 days or so in advance and say, on this date, you're going to be defaulted into saving more You're going to be defaulted into saving into different investments. You always have full control over your money, how it's invested, how much you're saving. And if you want to do anything different, here's your opportunity. So I think that communication is key. What do you think about participants pushing back, Kevin?
Well, I think we looked at the, from the previous two slides, 1 in 8 participants will opt back out from re-enrollment, and 1 in 5 will opt out from auto escalation. So you're always going to have people that, opt not to participate in the plan, but, your average participant, once they get auto enrolled and once they get put in auto escalation, typically will not make any changes.
Sometimes I get questions from clients like, this does seem paternalistic. What's the risk to me as a company? Do I have any fiduciary responsibility in doing this or not doing this? Is there any risk to my company?
Well, I mean, these are features, these are plan design features that the DOL has approved, to be inside your plan design. So again, you are showing that you're taking an active stance in your employees' participation in the plan. So this is part of your due diligence process. So from a fiduciary risk standpoint, these are things that you should have in your plan.
Awesome. Well, we've touched on some of the automatic features. Let's look at some other ways that you can move the needle. Probably one of the best ways is by offering an employer match who doesn't like free money. That's how a lot of participants view the employer match. And so if you look here at this chart at the bottom, you can see some common match thresholds. And it's probably not surprising that you see, the most common here in the center, where a lot of plans will offer a match somewhere between 50 to 100% of 6% of employee deferrals. And so why that's not surprising is that's where the safe harbor match is. That match is 100% of 3 plus 50% of the next 2. So essentially, if employees save 5%, the employer match is 4%, and that safe harbor match, gives certain administrative waivers for testing and other things. So a lot of plans do tend to adopt it because of those waivers. But if you're trying to get a sense on what type of match should my company offer, how much should it be, here's some good data. There's definitely plans that do less, plans that do more, but that could be a good starting point if you're having those conversations. I think one of the most important things, though, is actually, how you structure your match. So, 10 or 20 years ago, we saw a lot of companies offering what we call traditional matches. And so that would be something like 100% of 3. In the last decade or so, we've definitely seen a trend towards something called stretch matches. So rather than 100% of 3, this would be like 50% of 6%. And so what you're doing is you're encouraging employees to save a little bit more to get them closer to that goal. Many financial experts say, they should be saving at least 10% of their pay. And so if you think about how employees view their match, again, saving for retirement is difficult. There's so many different calculations. How much should I save? What should I be invested in? A lot of participants are really looking towards your match as guidance for how much they should be saving. And we do see a large percentage of participants will structure how much they're saving around how your match is developed. So if you look at some survey responses here, 30% of employees view the salary match as a contribution recommendation. 21% say they'll set their contribution rate to what my employer will match. And I think this next one is pretty interesting. 19% interpret the percentage specifically as what their employer thinks they should be saving. So if you really want to make sure that your employees are on the right path towards retirement, you can set your match at a place to, get them to that place from the get-go. So if you think of 50% of 6, the employee's putting in 6, you're putting in 3, they're saving 9%. They're already pretty close to that 10% many experts recommend. And then from there, you could even implement things like auto escalation, getting them to 10% the next year, 11, 12, 13, etc. And so that's a very easy way to get them to save a very good amount without it being, necessarily a big reduction in their paycheck right off the bat.
Hey, Adam, would you think that, or would you say that plans that either don't offer a match or historically have a very low match typically have lower participation, and as the match increases, participation increases?
Oh, definitely. Yeah, that employer match is one of the most enticing ways to get people to participate in the plan. And so, sometimes we talk with companies and they say, well, I really can't afford a big match. And, that's okay. Start wherever you can. If that's 1% today, that's great. I've even seen companies that, have updated their match each year, kind of in an auto escalation format to, maybe offer a 1% match the first year and then a 2% match the second year, with the ultimate goal of matching 3%, 4%, 5% long term. So start where you can, but that's definitely an enticing reason to save.
Well, with that, let's jump into poll question number 3. So what is the average number of investment options offered in a typical retirement plan?
All right, so we got less than 10, between 10 and 20, between 20 and 25, or more than 25. All right, let's see what our answers are. All right, most people thought between 10 and 20. Looks like it was kind of split between less than 10 and then between 20 to 25, and just a few people said more than 25. So really pleased to see a lot of people didn't say more than 25. As as we go to our next slide, again, the whole focus of this call is how to increase employee participation. And many people wouldn't think that the amount of funds you offer in a plan has any impact on that. But what we actually see is that if you offer too many funds, that can actually discourage participation in plans. So there have been some really great academic studies, one of which was done by the Wharton School of Business, and they found that once you get beyond 30 investment choices, that's when you see something called paralysis of analysis set in, and people say, oh, there's 40, 50, 60 different options. I'm not going to take the time to research that. Maybe they stuff their form back in their folder and actually never participate in the plan. Below 30, there doesn't seem to be much impact on participation, but we think kind of that sweet spot is in that 20 or so investment option count, because then you have plenty of different options to allow for diversification, but not so many that it becomes overwhelming.
And one thing to point out too, a lot of plans utilize what we call the target date series of funds. When you are looking at the number of investment options inside your retirement plan, even though your target date series has anywhere from 10 to probably 15 choices, those are just considered to be one investment election. So when you're making that count up, don't think, oh man, I'm going to have 40 different choices. And if I add these other funds, just count your target date as one investment choice.
Yeah, that's a good point. So basically it would be, your stock or equity funds, your bond funds, if you have any risk-based portfolios, and then you'd count the target date funds as just one option, even though there's, 5 to 10 of them. All right, so, I've said a couple times through this webinar that saving for retirement, there's a lot of different calculations that need to go into it. And frankly, a lot of it can be overwhelming for participants at times. How much should I be saving? How should I be invested? And so one of the ways we think that you can really help participants feel confident in participating in the plan and therefore increase participation overall is by offering them, either education or advice. And so you look across, some of the common things that participants are looking for help on, and it's determining what age I can afford to retire. How much money do I need to save for retirement? Can I get advice on how to invest in the 401k plan? And so this is where I'd really encourage you to rely on your provider. Some providers will offer education, things like what's the difference between stocks and bonds, what are the provisions of the plan, what are the investment options. But what can actually move the needle a little bit more is by offering advice. So, in a lot of our plans, we'll talk with participants and say, hey, Tim, you're 40 years old, you're looking to retire in 25 years, you have a wife that's a school teacher, has a pension, how should your investments be structured along with your Social Security to make sure that, you're on track for retirement? And maybe that comes back and we say they need to be 80% in stocks, 20% in bonds. We'll give specific recommendations about what makes up that 80% and that 20%. But, the more information and specific advice you can give them to their unique situation, the more confident they'll feel and the more likely they'll be to participate in the plan.
And one thing we would point out, again, Adam brought this up earlier, lean on your providers, your record keeper, your financial advisor to give that advice. If employees are coming to you, plan sponsor, investment committee member, managers within the business and asking, hey, what are you invested in? How should I be invested? Push those participants back to either the record keeper or the advisor for that advice. You need to stay away from giving, what could be construed as investment advice.
Definitely. And I mean, these should be part of their services. So no reason not to, send them to the provider and, take advantage of their services.
So falling back on that education and advice slide, this is virtual account reviews are a feature that we, with the pandemic, put into our plans. And this is the ability for somebody, a participant in a plan, to go in and schedule a 30-minute time block with a certified financial planner to talk about things that they might, feel uncomfortable asking in a group setting. So, are my investments appropriate? How much should I save? We get a ton of questions on, hey, what's the difference between a pre-tax contribution and a Roth contribution? So this is a way for a participant to feel really comfortable and work with a true certified financial planner. We see a lot of platforms out there talking about adopting this particular type of feature, but we're happy to say that we think the first to actually offer this, and it's been just a great feature for our participants.
And so one of the neat things, if you look on the right, you see a picture of a woman in the iPhone. So that's Marie. It's not a stock photo. So Marie is one of our certified financial planners that does these all day long for participants. And it's been so popular, we've actually brought on other staff members, other CFPs, to offer these one-on-one consultations, with employees. And really the ultimate goal of these is to just be one more tool so that they can get the advice they need, they can feel confident in their decisions. And all of this comes back to, helping them participate in the plan. Because if they feel that they have the proper resources in place, they're going to be that much more likely to want to participate.
Another way to really get people to jump into the plan and participate is demonstrate the appeal of your retirement plan. So this is a slide that we have in all of our enrollment books. So we walk through somebody who's not participating, and then we walk through somebody who's participating in the plan, and it's very easy to see. It's a very visual and tangible way for an employee to say, hey, if I put 6% in the plan, I'm only losing $71 out of my paycheck, but I'm now putting away $121 with my employer match. And over, I've got probably 25 years to retirement. So, it's a great way for me to look and see that if I put in that 6%, I could potentially walk away with about $200,000. And that would, if I weren't participating and somebody showed me that, that would be a great incentive for me to jump into the plan.
Yeah, and if you think back to those employee meetings, so we do employee meetings all the time for our retirement plan clients, and we found this was a really good way to get them to make that short-term sacrifice because we get it. I mean, $70 out of your paycheck, that's money that you could be using to save for vacation or Christmas presents at the end of the year, or just go out and have a nice dinner around town. So what's the best way to tell them or get them to make that short-term sacrifice? And we found that if we can really quantify it in terms of how this money can grow over long periods of time, that a lot of people are really inclined to make that short-term sacrifice. If they know that by sacrificing $71 each paycheck, that over 40 years it can grow to almost 700,000. We've seen a lot of people say, all right, sign me up, I want to participate right now. So demonstrating that appeal can be a really good way to get people to, actually sign up and start participating in the plan. So I know we have a lot of HR folks on the call, and so, 401k is probably a major part of your benefit package. You might have medical, dental, vision, retirement. So make sure you advertise exactly how great this benefit is. You can use that last page as an example. But the more you communicate this to your employees, the more they're going to hear it, the more they're going to value it. And so a couple different things you can do, to really get that word out there. Some of our clients do quarterly employee meetings. If that's too frequent for you, maybe look at semi-annual, but get people together, talk about the provisions of the plan, how to participate. Maybe you can reach those folks that are sitting on the sidelines. But you don't just have to talk about the same thing every quarter or every 6 months. Sometimes with some of our clients, we do other presentations, and it could be, how do you maximize Social Security? How do you talk to family about money? If you're young, how should you prioritize paying down debt versus saving in the retirement plan? So there's plenty of different ways you can get people together and start talking about saving for retirement, the 401k plan, 403b plan, et cetera. So the more that you can do to communicate that benefit, definitely the better. And so one thing we recently did at the trust company is, we found a way to quantify exactly how much that benefit is for each employee. And we have an example here on the next page.
Yeah, so this is something, again, like Adam said, to quantify what that benefit is. And you can, correlate it with, again, if you have that auto escalation, this could be something that you give out annually when you do that auto escalation, when you do raises, or it could be on April 1st to coincide with 401k. So April 1st, the 4th month, so 401k day. And it's just a good tangible way for somebody to say, man, my company is really helping me get towards retirement. And if somebody else sees that that's not participating in the plan, they're going to have that fear of missing out on something and are more likely to jump into the plan.
Yeah, so at the trust company in the beginning of February, we held a 401k party. We didn't have it April 1st, so we couldn't take advantage of that 401 pun, but we did schedule it to begin at 4:01 p.m. And so what we did was we got everyone together. We talked about the match, and afterwards sent out these individualized certificates to say, here is what was contributed to your account on behalf of the company. And so, as HR folks, as company owners, this is how you can really communicate the value of the benefit to your employees, really attach that dollar symbol to it, and just have them appreciate what you're offering to them that much more. So this can be a really good way to advertise that benefit. And we had a lot of this was the first year we did it. We had a lot of employees reach back out and say, hey, this was a really neat idea. And I think they appreciated the benefit that much more.
I know I did. It was great. No other company that I've worked for has done something like that. So it was a great way to see, wow, I'm getting a great benefit here.
All right, so with that, we're going to conclude the formal part of the presentation, but would like to open it up for questions. Let's take a second to let everyone submit those, and we'll see what questions come in. So we'll give it just a second to see here. let's see. We do have a couple. So Kevin, here's one for you. If I were to shorten the plan eligibility, does that affect the vesting schedule for my match?
Uh, no, those two really, don't really coincide with each other because you could, your match is if you have a graded vesting schedule over 6 years, however many years you have that match set up, allowing people to get in just sooner just allows them to participate in the plan sooner, but they still have to meet those vesting requirements to take full advantage of the match should they leave your plan.
Okay. Well, we have another one here. I can take this one. So if my plan participation increases, won't that cost my business more money in terms of match dollars? And so definitely, that's something you definitely want to consider on the front end. The more people that participate, and if you have that company match, the more people that will qualify for that match. And so, there's definitely that upfront cost. One thing you might want to consider though is, what if these people don't save for retirement, they don't get that match, where are they going to be 30 or 40 years from now? Are they going to be 70, 75, 80 years old, still working for your company? I think most folks want people to retire whenever it's the appropriate time for them, and don't want them to continue working because they have to, only because they choose to. Got another one that came in. I know safe harbor plans allow for immediate vesting. For other plans, is there a regulated or normal vesting schedule? Kevin, you have any thoughts on that?
Um, you can, that's up to you as a plan sponsor. You can have immediate vesting, or you can have, there's a couple different types of vesting schedules allowed. There's a cliff where that could be, you get 0%, you're 0% vested until you hit the end of year number 3, or there's that graded vesting schedule that allows for, 20% per year until you hit the end of that 6 year. You can change those around a little bit. You just can't be more restrictive than what the DOL IRS regulations are.
And if you have any questions, I'd say this is something that you should work with your provider on to say, okay, what's my workforce? How quickly do they turn over? Because with that vesting schedule, that can create forfeitures, which you may intend to use as part of your match funding. So definitely work with your provider, and they can give you some guidance on what's appropriate for your plan. So thank you for that question, Linda. And looks like we have another question here. Can my HR team conduct education campaigns focused on investments?
I would say you can conduct broad-based, more education campaigns on specific plan features. I would stay away from those investment questions. Fall back on your providers, your record keeper, or your financial advisor for those, anything pertaining to the investments. You never want anything to be construed as investment advice unless it's coming from your providers.
Awesome. Looks like we have another question here. Can participants opt out of auto enrollment or auto escalation or change their contribution rate at any time? And I'd say yes to all three. So, as participants, you're always in full control over how much you're saving and how you're invested. So, one of the benefits of auto enrollment is that it uses that inertia in participants' favor. So you always have the ability to opt out, but basically the default is you're participating unless you choose otherwise. Same with auto escalation. The default will be there's that 1% raise annually or at a certain period in time. But again, you always have the ability to opt out of that and change how you're invested. Boy, a lot of questions today. It looks like we have another one. If you have default investments with auto enroll, can participants change their investments?
Sure. Yeah. Participants are, like Adam just said, they're in full control. So if you're auto enrolling at 3% and your default fund is the target date fund. You know, how a participant gets into that default fund is they make no investment election. So if you auto enroll somebody at 3% and they go in and make no investment election at all, they will automatically default into the target date fund. Then let's say a year down the road, that participant decides they don't like the target date fund anymore and they actually go into the plan, they can change those elections. So yes, the participant again is in control at any time.
So we have a really good question here. Who is the beneficiary if someone is auto-enrolled but no beneficiary form is filled out? Definitely a good question. So, you know, typically that's written into the plan document, or there will be a certain automatic order, and you know, it like in our plans, it goes to your spouse first, then your children, then their parents, if any are surviving, and finally, if none of the above three, then your estate. So, you know, that's definitely a consideration with auto enrolling people because, you know, sometimes they're automatically enrolled and don't necessarily take the time to go in and update that information, but your plan document does, you know, provide that backstop.
Great question.
Looks like there's another one. This is a beneficiary question. Who is responsible of reminding people to change when family status changes occur? So I'd interpret this to mean like, you know, if there's a divorce or you have additional kids. Kevin, do you have any thoughts on that?
Honestly, I think that's an education. That's an education piece. You know, I know when I come in and do enrollment meetings, do education meetings, I typically end by saying, hey, you need to make sure that you're at least reviewing your beneficiary designations every 3 to 5 years because everybody has life changes. You know, divorce, death, birth of a baby, anything like that. So anytime that happens, you should be going through and updating your beneficiary information. But again, at least looking at it every 3 to 5 years, and having somebody proactively remind you of that is always a good thing.
So I would say the ultimate responsibility falls on the participant. You know, it is their account, but there are some backstops in there to, you know, protect the participant and the plan. You know, writing that into the plan document definitely helps. But I can tell you that, you know, some providers are a little bit more proactive in looking at that than others. Like I had a client that I was working with, and I'm able to pull, you know, beneficiary elections for every plan. And I actually pulled it in advance of a plan review meeting, and a company with, you know, 35 employees, not a single one had a beneficiary listed on their account. So I brought that up at the plan meeting and said, you know, this is something we really need to, you know, have a focus on over the next couple months. We scheduled employee meetings and then, you know, had beneficiary forms at the meetings and asked people to fill those out. And so that was a really good way to get that information updated. All right, I think we reached the end of our questions here. So let's want to give a shout out to our next webinar. So again, we're doing these Retirement Plan Academy series monthly. Our next topic is going to be student loans as a retirement benefit. So there's been some interesting developments. We've seen a lot of legislation attach different proposals linking student loans and retirement plans. None have passed yet, but it looks like something that could be coming in the immediate future. And there were some recently passed tax credits available with the stimulus package passed in December, so we can give you an update on theirs. But this webinar is Thursday, April 29th, 10 a.m. You can register at thetrust.com/RPA, but there's also a link in our little navigator over here. So if you'd like to sign up right now, go ahead and click that link. And would like to thank everyone for your time and participating today. And as a reminder, you know, if you are looking for those HRCI or SHRM credits, we'll follow up with you next week and send those out to you. All right, have a good day, everyone. Thank you.